Good evening to all the participants. Today we are having a webinar on international taxation, and we are having with us CMA Harish Joshi. He is a practicing cost accountant and an advocate with more than 10 years of experience in advocacy in international taxation and direct taxes. We are happy to have you here today, sir, and we request you to continue with the session. Thank you.
Hello everyone. First of all, good evening to everyone. So, today we all are gathered to hear about this international taxation. It's a very good topic, and from long time that we were thinking to have a webinar on international taxation, and finally that did come that we are discussing with with the members uh, or the professionals with respect to the international taxation. So first, I will just give you insight about the international taxation, how it developed and what are the key areas that and the key agreements or the key treaties are there, and which are very important, very crucial at the time of developing the international taxation, because in early 70s or 80s, the people started moving from one country to another
Sorry
country.
to interrupt you, sir. But we think there is a small technical glitch, like from your headphone as well as from your laptop. There is an echo which is happening from both the ends. We are receiving the sound.
You both the hands. Okay, just a
So there is
minute.
an echo. Your voice is coming up twice.
Now it's fine.
We will wait for
My
a
voice
moment,
is
sir.
coming fine now.
So we will, sir, kindly continue with the session. In case we are having issues, we will get back to you.
Okay. So I drop out my headphone. So I will I will discuss on this international taxation without headphone. Hope my voice is clear to everyone. And so I was discussing about the international taxation that earlier that initially, like in the 16th, 17th century, during the time the people started moving here and there for the business purpose, and there should be some during the time there was some treaties or there are agreements are there, but which are not in a formal shape or which is not followed or abide by the other country. So that is why and in people other countries started levying or collecting the taxation as well on that foreign trade. So during that time, there must be a requirement of one international treaty, and that has to be followed between the countries, trading countries, so that later on there is no dispute in terms of during the trade, and later on after doing that during the trade, and it is good for the economic and the foreign trade benefit as well. So I just means taken out this information, very useful information. So first I will give you insight about the Vienna Convention, very important convention. So that is initially started like during the Vienna Convention, approx 100 plus countries was there in 1969. They gathered together and to find a solution, because like there could be scenarios that one party is like if a state, if a country A and country B are doing foreign trade, and after the trade that there are certain scenario happened that other parties denied to following the treaties. So that is why there should be some like the binding or some uniform practice should be followed across globe, so that there is no challenges later on. So that is why the 100 plus countries like sit together to form a treaty which is called the Vienna Convention treaties, which is called like the it is you can say that the mother of treaty, that because like this actually gives an introduction, this actually gives a power and actually explain that why the treaty is binding to other countries. So Vienna Convention, as you have able to see in my screen, so that is it is in 23rd May 1969. The people are the countries are gathered together and laying the foundation of new treaties. So means it simply offered as this Vienna Convention. We called it a Vienna Convention Treaty, VCT. So it is internationally accepted, and during the time is what agreed that how we can make a better policies for foreign trade so that it is ease for the trade. So this Vienna Convention actually provide a way out to find any litigation or find out any challenges or dispute between the countries. So it give about the interpretation, it gives about the termination, it give out the conclusion, it gives about the enforcement of the treaties signed between the two countries or the multilateral agreements as well. So it very important discussions and very important topics or very important treaties that which can handle or provide a solution for international disputes, like to handle any to handle the case at World Trade Organization level and the International Court of Justice ICJ level. So before the codification of Vienna Convention, as I mentioned, that it was inconsistent treaties were there. Like it was ambiguities are there, and there were no options are available to correct these treaties, and there is no codification. How we can agreed or how we can give gives a statement or give a opinion or give a judgment to other party that actually that this need to be followed by both parties in a good faith and then in the transparent manner. So after this Vienna Convention, this inconsistency and this ambiguities has been reduced up to a certain level. And so this is very important in terms of treaties. Like whenever you are doing international taxation, this Vienna Convention is very important. It gives an insight because section 2.3 are very important in terms of enforcement changes, and section article 31 are very important. So I just quickly jump out into article 26, which is you can say that the crux of this Vienna Convention, which having a Latin phrase which is called pacta sunt servanda, means every treaty, if it is signed by the bilateral treaty, multilateral treaty by the countries, it should be read in a good faith and should be bind by the all the state in a good faith. I mean, no state can go out for any commitment which has agreed and signed by that particular state in their treaties. So it gives a treaty are legally binding, and state must honor their commitment in good faith. Without it, treaties would be nothing more than statement of intent with no guarantee that state would follow through their obligation as stipulated in the treaties. So I just give you one example of a very good case. I hope you are aware about the case Vodafone case, which is we called a landmark judgment, or which is called a very good case in terms of international taxation and for the transfer pricing point of view in India. In 2011, there was a transaction between the Vodafone and Hutch. During the time, the transaction is not in the territory of India because both the parties are located outside India. They are not in India, but eventually the entity which is holding the asset, which is located in India. So, but the transaction was happened beyond the control, beyond the territory of India. So during the time, it was observed by the officer that since the asset is located in India, then it should be taxable in India. But during the time, the section 9 was not covering the indirect transfer. So that is why the Supreme Court, through the special leave petition, has clarified that this should not taxable in India, since it accrue or not arise in India, because indirect transfer is not covered in the income tax. But Indian government has made some conspiracy and make amendment from the retrospective date from 1961 to cover the indirect transfer, which is bad in law. Always law says that any amendment should be followed the prospective, not the retrospective. And then the case has moved to the international court and the dispute resolution mechanism as well at the international level. In 2021 or 22, then finally, because after the dispute resolution pressure, India has taken out this case and foregone the entire the taxation on this indirect transfer, whether it's a withholding tax under section 195 or whether it's a tax income tax to the foreign parties under section 9, under section 9 subsection 1 and explanation number 5. So finally, due to this, because Article 26 is say every treaty must be followed in a good faith. You cannot do retrospective amendment. When any transaction has happened, you cannot do any retrospective amendment. And for any interpretation, which is signed by the bilateral governments, that has to be interpreted in Article 21, 31, because there could be chances after signing the treaties, there could be chances that many changes in the domestic legislation or due to certain changes, because every year the law has changing due to the developed economy, developed new challenges. So even the digital economy as well is one of the factor to frequent changes in the law. So Article 25, 31, Article 31 emphasize interpreting the treaties according to ordinary meaning of the term in the context of their object and purpose. This textual approach is supplemented by Article 32, which allows for additional source of interpretation when the meaning of ambiguous or lead to an absurd outcome. So I will brief you about this Vienna Convention, and I give you one example Vodafone case as well. The Pacta Servanda, every treaty must be followed in a good faith. There cannot be no country has a right to levy any taxes from the retrospective date, because Article 26 is saying that every treaty must be followed in a good faith, and every commitment that you have done in the treaty must be followed, must be adhered, and you cannot take out any step to ignore your responsibility if you agreed in the treaty. So I just give you example of the few treaties, few articles of Vienna Convention which are very important, and I'm not covering here. You can read it through the Vienna Convention, because Vienna Convention having 45-50 articles. So the useful article for us is at introduction, Article 1 to 5, which gives the introduction and regular changes as well, and the conclusion and entry into force, that is in Article 6 and 18. And observation and application, Article 26. Article 26 I already clarified, which is very important, and you need to be make sure that this like whenever there is any negotiation, you are part of any discussion for international matter, you need to be focused on this pacta sunt servanda, that every treaty must be followed in good faith. So treaty is a binding document between the state A and state B, that they cannot skip out the responsibility from the treaties which they agreed. So these articles are covered 26 to 38. So till 38, you will see the interpretation and other enforcement or the termination, other article as well, which I am not covering here, because here we are discussing about the international taxation, and this Vienna Convention covered the other treaty matter as well. So that I explain about the Article 26 and Article 31. Then I quickly move into this very important matter, which is this. I hope that whenever you are seeing any international taxation demand or international taxation webinar, you are able to see that there are always government are referring, or the tax consultant or any tax advisors are referring the OECD Model Convention, OECD. So we need to understand first what is OECD and why OECDs are very important, because as per the Indian, we are not members of OECD, but we are a consultant or advisory members, or we are responsible members for the OECD. So India is not part of, there are 40-50 countries are part of OECD, but we are not part of OECD, but we are you can say that we are a responsible or always give an opinion about any taxation with respect to any matter, and we are participating in their event as well, OECD. So if you see Indian transfer pricing section 92, if you start from 92, so if you see in the section 92, you're not able to find OECD reference, even the United Nations reference as well, because we are not following we are not giving any reference of OECD United Nations, but indirectly we are following the OECD. We are attending the webinars, we are attending our tax officers, principal commissioners of international taxation, competent authorities, those are dealing in APA, those are also going to visit OECD seminars internationally and become and going for decision making strategy or seminars as well to give their opinion as well. So I will explain that there are two important treaties which is followed across globe. The first one is the OECD, which is previously called as the Organization of European Union Cooperation. Now we called as a OECD, Organization of Economic Cooperation of Development. So initially, this OECD has been started, I think, in late 1968. During the time, there was no fixed format like how we can draft. Let's say example, if you want to draft any leased agreement, if you want to draft any conveyance agreement, if you want to draft anything, you can say that any rent agreement or the power of attorney. If there is no standard format, uniform format, everybody can write whatever they want. They can cover the matters different. So it is very difficult to follow the cross word the uniform articles. So that is why OECD has given an OECD model text convention, which gives the articles how you can draft your treaties. Whenever state I'm referring, if you go by the international taxation law point of view, state means the countries. So whenever you are saying any treaty where you have seen that state means the country, and treaty means it's an agreement, it's a convention. So, so initially the OECD has formed in 1968 by the United Nations Economic and Social Council. So that is for the developed countries. So there is a question raised in the people mind. Then why there is a requirement of United Nations? If already the OECD Model Tank Convention are there in the world, then why we would require the United Nations Convention? Because the OECD is referring that the develop means the resident based taxation, that they are giving very less right to the source taxation, developing nation to collect taxes, and which will eventually impacting the developing countries expenditures, because eventually the tax is a major revenue for them to develop their countries. So like India, the taxation are very important in terms of managing the expenditure. So every budget, our finance minister is specifying that this type of expenditure we will take on, we will consider for the upcoming session. Why? Because we have a good revenue in terms of direct and indirect taxation. So OECD is always emphasizing on the resident based taxation, that they are giving very less right to the source taxation. But United Nations is a different theory. They are actually following the same pattern which is followed by the OECD, but it provides that it gives a higher or the most right to the source taxation, that who is eventually consumer, who is eventually recipient of the service, where the service are actually delivered, accrue and rise, that has the right to levy the taxes. You cannot skip this. So that is why the two model tax conventions are followed across globe. United Nations, which is for the developing countries, like the Bermuda, this other Commonwealth countries, and other than this, across European Union, the Spain, Uruguay, Chile, France, this in the Africa as well, the Egypt, and in Saudi Arabia as well, in the UAE as well, in the UK as well, all are followed the OECD, and US having their own model tax convention. Because US always followed a different perspective, different view in terms of international taxation. So they have a different model tax conventions in their country. So, but all if you compare all of these, it look like similar. The standards articles are similar. Only the certain languages are different, which is very important to need to be considered, need to think whenever you're analyzing whether this country is following the United Nations or the OECD. Because in India perspective point of view, whenever there is a transfer pricing assessment, tax officers are referring to United Nations guidance as well and OECD guidance as well, because India has nowhere in the Income Tax Act 1961, even in the previous era, because in the previous era it was not applicable transfer pricing, but it is starting from 2000 when the FEMA Foreign Exchange Management has enacted in India after this FERA. So after that India never specified that we follow the OECD or United Nations. So for us, for India point of view, we followed both treaties. We followed both model tax conventions, whether it's OECD or United Nations. We followed both. Tax officers are referring United Nations and OECD. Even if you are submitting any response with respect to 97, 92 CA with respect to transfer pricing assessment, 92 2D with respect to any documentations, you can always give a reference to the OECD and United Nations manuals, OECD manuals guidance note, that these are the options or the observation that has given by the United Nations in the example that need to be followed for that particular transaction. So it's very important that always you need to think about that OECD and the United Nations. There are two pillars of this format of international treaties agreement. But there is a certain difference that OECD is emphasizing or giving a more right to the resident taxation. On the other hand, the United Nations is giving more right to the recipient, the source state, because source state is a developing state which require more revenue as compared to the developed state, the resident state. So that is why the United Nations has been a separate statement. It's not the same statement that OECD is giving. Only the changes is the rights, that the right has given more to the resident source taxes. So the main difference, if you see, between the two model convention is that United Nations model convention impose fewer restrictions to taxi right of the source country. That I already explained you that United Nations are giving more right to taxi right of the source country, therefore have greater taxing right under it compared to the OECD model tax convention. For example, unlike Article 12, which is called for the royalty, meaning use of any intellectual properties, right to give a licensing use for any intellectual property, where the recipient who actually invent that intellectual property charging any fee, charging any remuneration, which is called a royalties. So if for the royalties, as per the OECD model convention and Article 12 of the United Nations model convention does not prevent the source country for imposing tax on the royalties paid by resident of other country to resident of other country. So United Nations are not preventing to source country for imposing tax, unlike this OECD are preventing preventing source country to levy and collect taxes on to a source country and giving more right to the resident country. The United Nations Model Convention also gives the source country increased taxing right over the business income of non-resident compared with the OECD Model Tax Convention. So then I just explain you about the Vienna Convention, and then I explain to you the OECD and United Nations as well, that during the World War II, that the people started moving here and there for the business purpose, and there were no standard formats were available. And then the the Organization of European Union has finally form a uniform or a binding document, which is called a OECD Model Tax Convention, which is for just to drafting any treaty between state and state. So this is just example that how the OECD Model Tax Convention looks like. So always in the top of the page, in the top of the OECD Model Tax Convention, you will see that convention between a convention. This is a convention, mean the agreement between state A. Here the state A referred to country, and state B means it's an agreement between the treaty between country A and country B for the avoidance. Please see carefully. It is about the avoidance of double taxation, not avoidance of taxation. You need to be sure that it only talks about that one income must be taxable in one country rather than taxable same income in two countries. So it is only for the avoidance of the double taxation, not for the tax evasion. You need to be more careful whenever you are like reading this article. You need to be more careful that the income should be taxable in country A and country B, because if in case it is not taxable in country A, there should be some reason, because it is only for the avoidance of double taxation. Because in case the income is not taxable in one of the countries, tax authorities are raising question. There are many case laws in India which mention that the income is not taxable to India due to the permanent establishment, certain rights, certain benefit, which is given as per the section 90A 90 to the non-resident to suffice that they are not resident of India, and they do not have the permanent establishment as per Article 5 of the bilateral treaties between the country and country B. So, but tax authorities are going further as well. They are checking whether the same income is taxable in the foreign treaty or not. If not, they are raising question. They are creating doubt. So always remember that this treaty is not for the tax evasion. It is for the avoidance of double taxation. So you need to be more careful whenever you are reading, whenever you're giving opinion, whenever you are giving suggestion to anyone. Be careful that you need to be sure that it is for the avoidance of double taxation. It is not for the tax evasion purpose. So, and with respect to taxes on income on capital, so it talks about income. Incomes can be many types, like immovable property income, like the business income, like the other income, which is called residual provision in the article 22, and and capital gain as well, income as well, royalty as well, fee for technical services as well. Fee for technical services is not captured in the OECD border tax convention, but is part of India treaties, and it's part of US as well, wherein we called as FIS for like where we call it FIS. So it is similar to FTS, a fee for technical services, but it have a little small difference. So there are interest options as well, royalties as well, capital as well. So income covered this. Income covered from article 6 to article 13, then article 14 as well. I think article 14 now is not relevant for. I think in India it was there, but in internationally it was merged with the article 5 and the. So dependent personal services mean the employment services, and this is the director fees, artists and athletes, because for artists and athletes, whenever they like wherever they are earning the income, it is taxable in their particular country. They need to pay taxes, and so whenever you are reading treaties, you need to first check the article 1, the person covered. It tells about the country A and country B, like let's say Republic of India, Kingdom of Spain. If you are reading a treaty between the two countries, then they are referring this. And then second point, the taxes covered. Like in India, the income tax are there, TDS withholding tax are there, which is part of income tax. In Spain, the corporate tax are there, withholding tax are there. So they will cover up that in case any tax is deducted in other country, that tax can be offset or adjust against the resident taxation, resident income of that particular resident person. So in third, you will see the definition. What are the meaning of major definition that has specified in the particular treaties, which is very important. Which is as per the interpretation of statute. It is very important. The definition are part of always interpretation. Then the physical domicile mean the resident. Like for example, any person that who is temporary come for employment in India for a job, because in India for person to be resident as per section 6, then he must need to stay in India at least 182 more than 182 days. But and it is followed across in the world. The generally 182 for formulas are across world as well. And in case he stay in India more than 180 days during the year, then he could be resident in India. So that point need to be think about, because could be possible that in other country he is resident as well. So there are 4 type of parameters or 4 type of definitions are there. That first we need to check, like where he is a tax resident, where is a resident point of view, where is a citizen. If he's a citizen of both the countries, where is he is having the he or she is having the vital interest, means where his jobs, unemployment, or the properties are there. Then the other factors are also there. So there are 3-4 factors that need to be considered. I'm not discussing here because it's a very big topic, and there one article is enough or sufficient, means like we cannot cover up here all articles. We can cover up in one class only one article, because it's a very deep analysis article. Every word of that article must be read in a clear, on the transparent, and a very very timely, or very conservative, or very you can say that very conservative mindset as well. Because in case you interrupt the particular statement in a wrong way, there could be some tax leakages. So 4 I cover, that is a physical domicile, which is called a resident, and the 5 is a permanent establishment, which is very famous nowadays in India. Because if any person is coming to India for any job purpose, and he is a part of any entity who is doing the business in India, and if that entity is accruing or earning as per section 5 of Income Tax Act, subsection 2, any income accrue and arise in India to that entity, and that person stay in India more than 180 days during a year, then an entity having a permanent establishment in India, and there is no bilateral treaty benefits which is applicable as per section 90 and 90A, are not available that particular entity, and that non-resident entity is subject to 38.22. That is a foreign company taxation in India uh, for their Indian income. So that is why the permanent establishment are very important. There are other factors as well. So I just give you one example about the employment, that if any employee of foreign company has come to India for business purpose, not for the vacation, because vacation not covered in 182 days. And so it is very important. And even there is a concept across world which is called a virtual P, because there are many case laws in India as well, where the tax officer has gone further, where they have mentioned that the virtual P, because they established that it is a virtual P, because nowadays all the works are managed through the digitalization. Like I'm giving a webinar through digital form. So nowadays every person, because earlier there were requirement to for a one country to another country for rendering any services, supplying of any good. But for services nowadays, everyone can give a advisory or services from anywhere. So there is no requirement to physically move to the particular country. So that is why virtual P is very famous nowadays as comparing to service P. So that is why there are few cases that has gone to the High Court level as well, Delhi High Court, Mumbai High Court, and Madras High Court. But the authorities has clearly denied that virtual P is not part of our taxation, because in our taxation we never specified in the articles about the virtual P. So permanent establishment, and which is, so that is why the OECD is working very hard internationally to cover the virtual P as well. That is under discussion. Many countries like Saudi Arabia and other countries are thinking to adopt the same, and that could be possible that after some years, so after a few years, we will see the virtual P concept as well, because all of the services are under digitalization nowadays. And the sixth is income for immovable properties. Like you have any income from immovable property in any country. So any income you are generating, rental or any appreciation, that is appreciation is a part of capital gain. So any income you are generating from renting that property, so that is covered under Article 6. And Article 7 is the business profit. In case you have a permanent establishment, then you have a business profit. Otherwise, Article 7 clearly specified that if you are a resident of other country, if you are a resident of a other country other than the source taxation, and you are rendering services and you do not have the permanent establishment in that country, then it will not subject to taxation in the source taxation. It should be taxable in the resident taxation of the contracting state entity. And 8 is shipping, inland, water, sea transport. It is basically wherever the location of that transport, inland, shipping are there, then it is taxable in that country. And Article 9 is the associate enterprises. So it talks about that any transaction between the associate enterprises. So that need to be careful, because in India, the section 992, I think 92B is specified about the international transaction specification, that what are the related party transactions. So that we need to take care, like the controlling of directors as well. This is one of international transaction, that if the majority of your company is held by a company which is a non-resident and they are your related parties, so that transaction with that entity, even there is no equity investment, there is no hold, where there is a significant influence of control. So there is no control in your entity, like they are not holding, they're not holding, the entity is not holding company of your company, Indian company, and they are not the significant influence, like they do not have the equities like share percentage in your organization more than 20%, less than 50%. And so even though then entity could be considered as a rated party as per section 92B, they are specified that there are certain scenario that if the majority of directors, even it is mentioned in the MCA as well, whenever there is a significant influence as mentioned, and the control as mentioned as per IGAP article, as per IGAP standard 23. So a certain, whenever there is a transaction between the related party, that must be follow the arm's length, because this is the one of the criteria of multinational enterprises to shift the profit from low tax jurisdictions to high tax jurisdiction, because in the low tax jurisdiction you're not paying any taxes, but eventually you are getting benefit from higher taxation, higher tax jurisdiction for claiming that expenditures. So that is very important, that all transaction. That is why we are following the transfer regulation, because internationally, as per the bilateral treaties and the multilateral treaties, they have considered that associate enterprise transaction must be follow the arm's length principle. Then we move to the Article 10, which is called dividend. So dividend is earlier, like I think 2000, before 2023, dividend was subject to dividend distribution tax. So where the entity, the company who is distributing the dividend, and they need to pay the dividend distribution tax whenever they are distributing the dividend to the shareholders. So after making the changes, the dividend is subject to taxation. That the entity who is declaring the dividend and distributing the dividend to shareholder, the entity has to deduct the withholding or the TDS, because in case of domestic transaction they need to deduct the TDS, and in case of international transaction they need to deduct the withholding under section 195 and referring to Article 10 of the bilateral treaties of that particular shareholder country. So dividend is subject to and the particular entity, it is has to be taxable in India because it's accrue when arise in India. And because as per the Article 5 subsection 2, as per section 5 subsection 2, any income generated by non-resident for any income which is accrue when arise in India, that is subject to Indian taxation. And then Article 12, Article 11, which is talk about the interest. So if you see, we have a very good section which is called 94B, thin capitalization, which talks about the interest, that there are certain capping that India has given for thin capitalization, because what happened, like in the Middle East or the Gulf countries, the Mauritius, Singapore, Luxembourg, the many tax haven countries are the countries are preparing, US, European Union's country holdcos are preparing or holding their holdco companies there. It's just a letterbox company. They're not doing any activity or substance activities from there. Just a letterbox company to repatriate fund without having any tax levies, and so that they can get a good profit and they can reinvest that money into market. So they are what they are doing, because they are not subject to good amount of taxation, but India is subject to good amount of good percentage of corporate tax, which is now, earlier it was 30%, now it moved to 25%. If you follow the section 115 BAA or the BAB for manufacturing company, which is so earlier 30% tax was there. So eventually, if you are giving a higher interest, or like you are making your investment like 70% of debt or 30% of equity, like the NCD, OCD, or the CCDs, or any types of loan, the ECB as well. So if you are doing such type of investment or such type of infusion in Indian company, that is subject to deduction benefit in India, because eventually the recipient company is subject to take the benefit of this that interest under section 36, because it is part of their investment or for the business purpose. So that is subject to deduction, and eventually the Indian entities are not paying any taxation, and there is no taxation has been paid by the foreign entity, the multinational group in the foreign jurisdiction, because it was located in a low tax jurisdiction. So to avoid this, India has make a capping 30%. So the section 94B, there is a thin capitalization that any expenditure, any interest expenditure during the year incurred cannot be directly, you can claim a tax benefit of that interest while filing your company ITRs, that there is a 30% capping. That first you need to calculate your EBITDA, earning before interest, tax and depreciation and amortization, and then EBITDA 30% you can adjust during the year, and the remaining amount you can carry forward to the next IT assessment year, just like the business losses. So it is followed across world as well. Like UK has also the net interest income ratio as well. They have BEPS as well. BEPS for base erosion profit shifting as well. So interest restrictions, interest reconstruction, and the restrictions are there. So thin capitalization is UK is having more more awareness, or taking very seriously about the interest erosion to their local tax benefit. So that is why they are more focused on the interest, that there are certain criteria to be fulfilled to claim any interest in UK companies. So in the UAE as well, they have given a limitations that they have a global interest deduction rule as well, specific interest deduction rule as well. They are keeping at consolidated, whoever is the group means the parent company and the subsidiary financials where they actually consolidated. So they are taking group ratio as well to calculating the interest deduction for that particular entity. So there are certain rules followed across group. It's like in Spain as well, they have a thin capitalization. Europe as well, thin capitalization. Saudi Arabia is a similar type of interest, but like as most of the Saudi Arabia companies are not subject to CIT. Only the foreign investors are subject to 20% CIT in Saudi Arabia, because other local jurisdiction, local shareholders are paying only 2.5% zakat taxation, which is Islamic regulation taxes in Saudi Arabia. So similar like royalties as well. So whenever you are distributing or upstreaming dividend, upstreaming this royalties to your the royalty partner who is given the intellectual property to you, then you need to be you need to be ready with the taxation. But how you can take benefit of this? You can go for this double taxation avoidance agreement, and you through the double taxation avoidance agreement you can reduce the impact of the taxation. Then there is a capital gain. So generally what happened in the capital gain in terms of shares, because if it is connected to the immobile properties, it is worldwide across globe, that if the company is a land rich, then it is subject to taxation capital gain worldwide, UK, Spain, everywhere. Land rich are very important. If your company asset are 50%, like in case of indirect transfer as well, we are given a statement that what is the meaning of substantial asset located in India, that 50% of their value derived from Indian asset. So if any entity is transferred, so it is very important to check the land rich, whether this entity is a land rich or not, with respect to the capital gain point of view. But generally, as per Indian taxation, Indian organization, Indian government is not giving any relaxation for capital gain, whether it's a land rich or non-land rich, it is subject to capital gain in India, as according to section 45 to section 48 for computing the capital gain. And in terms of shares, you can go to section 112A for listed shares. So now the tax rate is uniform for non-resident and taxation, which is 12.5. So every like with the share or everything which is go in the bucket of this 12.5% long-term capital gain. And short-term, as you mentioned, aware about that, it is a part of slab. If it is not listed and if shares are listed, then it is part of 20% capital gain. So this is very important, that whenever you are transferring any company shares, you need to be see about capital gain. The capital gains are very important, because I have made few structuring in the past where we have taken out the investment from overseas and from India as well without paying any capital gain in India. And there are many judicial judgments are there which are in favor that capital gain are not subject to India. So there are many judgments are there. If you go for ITAT Mumbai, ITAT Delhi, you will see that there are many judgment as pronounced by the honorable members of ITAT, judicial members and the accountant member, that capital gains as per the treaty are not subject to tax in India. And this is independent personal services that I update you that in the Indian treaty is it there, but across the globe it has been strike off that now it is not followed because it already covered in the permanent establishment article 5. Then the article 15, which is a dependent personal service, which is employment. That any person like in India, the secondment of income is very familiar. That one person in the role of foreign company and rendering services to domestic company in another jurisdiction, and that domestic company is repatriating or reimbursing that money to their payroll entity. So this is the employment services that need to be checked, and there are very good examples are there in the OECD examples. Then the article 16, which is talks about the director's fees. Whenever you are giving a sitting additional directors any fees, that need to be part of article 16. And article 7 that I mentioned, that for artists and athletes, it is always taxable whenever the income is accruing and arising. Like if any sportsman, umpires, or referee is coming from foreign to India just for the IPL or Indian Premier League or for other ICC event purpose as well, then it is subject to India, because India is generally the treaties are giving favor to the source taxation where the income is actually they are generating. Here income must be discharged. So then I'm going to for the pensions as well, and because like in case any pensions for the government or other department you are generating, which is covered in Article 18. So it is not applicable to mostly in the corporate sector because pensions are not there. And the Article 19 is also not important because it is not because we all are working in the government private sector. It is only applicable in terms of any organization with the government functions. And Article 9 that I mentioned, it is a residual income, other income. So Article 21 always says that any income which is not covered or fit in the other articles of that treaty, that must be covered in this Article 21, which is called a residual article, and it must be taxable in the resident of that particular person who actually earn any income from source country. So Article 22 is the capital, means you all feel I mean there is a doubt came into mind the why there is a two capital, because in the previous slide we have seen this Article 13, which is a capital gain, and now again the Article 22 capital. So it is capital is just like a wealth tax, because if you all are remember that previously, like, because now income tax has given some super rich taxation benefit which is already covered in the slab as well. There that income tax slab can go to the 43 and 44% as well by inclusion of certain surcharge for higher net worth persons, higher income persons. But before that there was wealth tax were there. It is based on the net wealth of the company. So this Article 22 cover the capital. Capital means the net worth, your assets. You need to pay taxes on your asset. Then the Article 23, which is talks about the elimination of income. If it is taxable in one state has to give an exemption that it is not taxable in that country. So if the income is exemption in one country, then it should be 100% taxable in another country, and there is no tax credit is available because there is no withholding has been deducted in the country, or there is no taxes paid by that country. But in case the credit method, in case the credit is withholding has been deducted in the other country, then the foreign tax credit has an allowed by the other country. If it is denied, then there is a procedure called mutual agreement procedure, which is handled by the competent authority of every country. If any benefit is derived or denied under this treaty, then we can approach to which is called a MAP, mutual agreement procedure, where we can approach to the competent authority, where the competent authority will discuss with the other country's competent authority and take a decision, a conclusive decisions, and will update to the taxpayer about that particular benefit which is specified in the treaty. Then the Article 24, it is non-discrimination. So it is very important because there are few treaties like the Mauritius treaties and the US treaties, and there are very favorable most favorable nations clause as well for the Netherlands as well, which is enforceable only after notification of Section 90. So non-discrimination means recently Singapore has taken a benefit that in the Singapore and India treaty on dividend, there is a withholding of, let's say, 12%. But one of the treaty between India and Mauritius, the withholding was 5%. So Singapore has taken a benefit of the treaty, Article 24, that the non-discriminate. You cannot discriminate that country for, you cannot give a two different taxing right to different country based on their country's jurisdiction. So Singapore has approached to the government, approached to the courts in India, and they finally won the case, and they got the benefit of this non-discrimination benefit, and they are subject to the withholding as per the other countries withholding rate. Then the Article 5 that I explained to you, mutual agreement procedure. Whenever the treaties are not followed by other state, we can approach to the competent authority, CA, the competent authority of our country, that they will approach to the competent authority of other country. Then the Article 626, it is very important. I believe you all are aware that recently for any domestic company which is a part of MNE, multinational enterprises, where they have a permanent establishment or branches or subsidiaries outside their home jurisdiction, and their turnover were more than 750 million euro consolidated turnover. So then they are subject to master file preparation, country by country reporting preparation. There are a certain regulation as well, which is covered under Article 286, Section 286 of Indian Income Tax, and Section 92 for master file. So this is part of Article 26. If you see the 280 Section 286, they have specified that if there is no exchange information, then irrespective whether your home jurisdiction is filing the CBCR, you need to file the same in India. Otherwise, you only need to file a notification to the India mentioning that your holdco, the ultimate parent company, or any alternate reporting country, which is designated by your ultimate parent group for filing the CBCR, is filing. So we are just nominating or informing to the department, tax department. But in case there is no exchange of information, like there are many treaties. There nowadays it's very limited treaties, but India has not signed the treaties with each and every country across the globe. So that is why, like in case of any treaty between the Bermuda, previously we have not signed the treaty with Hong Kong as well. Now we have signed the treaty with Hong Kong. So if any treaty with the, let's say, Bermuda, so we do not have the treaty with the Bermuda. So in case any holding company of Bermuda, its a parent company of Bermuda has subsidiary in India, and they are filing the CBCR in their country, but but we do not have that bilateral treaties in place. So that is why Article 626 is not in force. Means it is not exchanging by the country A and country B for the economical or economic, to check the economic benefits in the future and the foreign affair trading benefits as well. So that is why we need to file it the complete country by country reporting in India. So that is one of the condition in section 286 for filing the master file. So this is for exchanging information, country by country reporting master file, which is according to the base erosion profit shifting BEPS 1, Article 13 action plan. Then the Article 27 is about the diplomatic and the consular officers, that the diplomat bureaucrats are coming for the foreign trade and embassy purpose in internationally to one country to another country. Then the territorial extension, entry into force, and the termination. So basically, this is I just give you examples, just give you overview the articles, that each articles are very in detail. I cannot give you or update you in one webinar about the same. It will take time because we will cover up in the next webinars, say one article by one article, and first we will go for the United OECD, and then we will go for the United Nations, and we will do some practical examples as well. I will cover up in the next webinars the practical examples as well. So this is basically I have explained and give you introductions about the OECD Vienna Conventions and about the OECD Model Tax Convention as well, how the treaty looks like. So that I already give already explained to everyone. So this is basically the one introduction section on the international taxation, and we can we can take any questions if any have, so that we can discuss, and I think then we can cover up the things. So can somebody raise questions, if any questions that we can pick up with respect to this today's introductory session?
Sir, we do not find any question and answers in the section. You may
Yes,
please continue with the session.
Yes, so it is good that that we are not getting questions. So I'm assuming that people are able to understand what I communicated, and so it is good that and could be possible that we as a members of institute are aware about the international taxation. It is very good thing that, because nowadays is very popular international taxations, and it is very important. I will just show you one treaty as well. So that you can see that how the treaty looks like. So it is easier because I give you example as well, but I will just give you insight how the treaty looks like. Hope my screen are visible to everyone. Priyanka ma'am, you are able to see my screen, right?
Yes, sir, we are able to see your screen.
Yes. So this is a treaty, just example of treaty between the Saudi Arabia and India. So So this is the treaty agreement which is available on the income tax portal of India. So every like the double taxation treaty is available on the income tax portal. So if you see that the language in the beginning, in the top of the agreement, it has mentioned the agreement for avoidance of double taxation and the prevention of fiscal evasion with Saudi Arabia. So it is a prevention of fiscal evasion and avoidance of double taxation. It is not for the tax evasion. It is only to avoid the double taxation. And whereas the next convention between the government of Republic of India, means India, and the government of the Kingdom of Saudi Arabia for the avoidance of double taxation and the prevention of tax evasion with respect to taxes on income. Taxes on income shall come into force of first day of 2006, being the first day of the second month following the month in the later notation complete, and accordance with the Article 20 of the Constitution, which is entry in force. So this is, and we are referring to Section 90 as well, Income Tax Act, which gives a power to any non-resident to be taxable as per the dilated treaties, not alone with the Income Tax Act. So every non-resident has a right, whether he's holding the pen or not, whether he's holding the permanent account number or not, he has a right because the treaty overrides the income tax. So always the respective person always has right to go for treaty benefits, because every government has right, and this is I already explained in the Vienna Convention Article 26 that pacta sunt servanda, that every article must be read in, every treaty must be read in a good faith. So if you go by this, you will see the person covered that it's applied to a person who are resident of one or both the contracting state. Then the tax is covered. In India, the income tax, in zakat and income tax. And then you go with this, then the definitions are there. What is the India meaning? What is the kingdom meaning? What is the contracting state meaning? What are the other contracting state meaning? So I will give you just example. This is a resident. Have you determined that the respective company, respective individuals are resident of India? How you can determine this? These are the articles are there. So because if any laws of life, if any person is domicile, place of management, so there are many criteria are there that need to be considered to conclude that the particular employee, particular person, particular non-resident is a resident of India. Then for companies, the business affairs, the management, where actually they are located, where the management are sitting, it is very important to show that where the resident of that particular company. And then it is called the permanent establishment. Permanent establishment are very important. So permanent establishment branch. So always take care, note that whenever you are opening any branch in any country, that always consider as a permanent establishment. But license office is not considered. Factory, workshop, it always considered as a place of management. So all of these activities are already considered as a place of permanent establishment, and that are subject to Section 9 business profit, which says that the profit of an enterprise in a contracting state. Contracted state means the state A shall be taxable in the other state unless the enterprise. So this is very important, permanent establishment. If you do not have the permanent establishment, you can see that may be taxed in another state. So it automatically takes burden of tax shift to the resident taxation in case of instead of the source taxation, if you do not have the permanent establishment. Then shipping and trade transport, then the associated enterprises that I discussed, then this is dividend. Because if you see the Indian taxations for withholding taxation, withholding tax, you will find that for withholding taxes, if you go to the section 115A, which is for withholding taxes on dividends, royalties, fee for technical services, and even to the extent of some interest as well. So it has mentioned 20%, but if you see this Article 10, which specified that it restricts to 5% only. So it is very important whenever you are processing, whenever you're doing any intercompany payments, whenever doing foreign company payment, you need to go with the article, because Section 90 and 90A clearly define that treaty overrides the income tax law. It always, because we have signed this treaty in a good faith, so we cannot take away any for non-resident persons any rights which is available as per this agreement, binding agreement signed by the country and country B. So if you go with this logic, you can see the income from debt claim as well, income from interest, then the royalties are there, the capital gain is there, independent personal services, dependent director fees, and the pensions, students, and other incomes. So if you see the other income, they have mentioned that item of income resident or contracted wherever arising, not deal with the foregoing article of this convention shall be taxable only that contracting state, means only the resident taxation, resident state who is earning the income, who actually earning that income from foreign jurisdiction is liable to tax in their home country, resident country, instead of source taxation. So there are very like detailed scenarios are there, and to understand this, we need to discuss each and every article separately, and we can take it the treaties as well to read the treaties. Like we are not able to see at capital gain because in India versus Saudi Arabia, there is no separate article for capital gain and for the fee for technical service and the royalties. So I will show you one different treaties which is signed between the India and United Kingdom, which talks about the capital gain. So if I go with this treaty, yeah, so yeah, this is a capital gain. So they have clearly examples that the local jurisdiction, because the taxes are levied as per the constitution of our country, that every taxation authorities have right to collect taxes, levy the taxes as per the constitution of India. So they have clearly defined that each contracting state have a right to capital gain according to the provision of the domestic law. Like UK has a law that if any non-resident is earning any income in UK, it is not subject to capital gain if it is not earned from a land rich activity or real estate property held by the respective subsidiary, and you hold a share on this particular subsidiary in UK, domestic subsidiary in UK. But in India, any source of income, whether it's a land rich or non-land rich, always it is taxable. So if you read by this article, they have clearly mentioned that you can ignore it. Article 8, 9, each contracting state capital gain. So if you see from India and UK tax point of view, capital gain is taxable in India, and that has to be computed as per section 45 to 48, 49 of Income Tax Act, and following the valuation method as per the rule 11U AB. So 11 UV and 11 UUV. So this is very important that that treaty must be read in a good faith, and whenever you are giving a decision, any conclusion, go in detail in this treaty. It is very detailed. You cannot take any benefit from this. There is an anti-abuse provision as well. Just I will go to this. Anti-abuse. Recently, government has mentioned the principal purpose test, that you need to produce the principal purpose test. That if the principal purpose test, the principal purpose of that tax structuring is eventually taking the benefit of taxes, then the government has a right, which is under section 94, which is under section 95, which is called the SAR and GAR, general anti-avoidance rule and the specific anti-avoidance rule. Government can discard that structure. They have a right. So this, if you see, they have limitations as well. Limitations of benefit. Benefit of this convention shall not be available to resident of contracting state or with respect to any transaction. So beware of doing any treaty shopping. And if you are doing any treaty shopping, it is followed across the globe. Governments are taking the substance. Substance are very important internationally. If you are not able to maintain the substance, there is no economic benefit in that particular country. Time has gone that previously, like the Google, very big players, Apple's, they established their headquarters in the Ireland because intangible assets were not subject to taxable in that country. But we all know that they are belong to the USA, but they have not established the headquarters. They established the Ireland, and they are taking lots of they save a lot of money due to this structuring. But later on, the Ireland government and other European Union and other governments have penalized the Apple and both the government as well to support in terms of managing their tax evasion. So nowadays, because due to exchange of information, many tax reportings, nowadays it is very popular, BEPS 2 as well, Pillar 2. It is already discussed, already implemented, enacted by the European Union. And other jurisdiction as well. Saudi Arabia is going to implement, UAE already implement, UK already implement, and every country, China, India, and US has a reservation. They will think about, they follow a policy to watch and wait and watch policy. So they will see. If you see that any undertaken by the such a region, if the main purpose, this is a very good principal purpose test, is is to take the benefit of that treaty, then this article benefits was not available to you. You need to be more careful that if it is produced from your submission, produced from evidence that the principal purpose benefit of this transaction was to gain or to evade the taxes, the tax authority has right to clearly discard the structuring and avoid and collect taxes in it. So, so this is very important. Like in income tax as well, I have clearly mentioned in section 95, you will find this about the GAR and SAR, specific anti-avoidance rules, and the general anti-avoidance rule that need to be followed and that need to be seen. And it is across the globe are same, because every country is having the GAR and SAR provisions. They have a GAR provision. So I mean in a different language or different interpretation as well, but all are already developed. So nowadays it is very difficult to take out any money without having any taxes, because earlier the tax haven countries are Luxembourg, the Germany, and the Netherlands, the Hong Kong, and the UAE, and the Saudi Arabia, and in the UK is also a good jurisdiction for tax point of view, because there is no dividend taxable in their country, and there are certain regulations on the capital gain as well, and Mauritius, so Singapore, so all of these countries are tax haven previously. So people are moving there, like the Cyprus as well. But now, say due to this stringent international tax compliance, it is quite difficult to manage the things. So that is why. So it's very difficult nowadays to take out any transaction, and because tax authorities are very regularly, they are discussing internally, exchanging of information as well through the articles, and they have a very good robust information with respect to the any transaction that you have undertaken with the related party, cross-border transaction, specifically cross-border transaction. So whenever you are doing any cross-border transaction, that must check from the arm length point of view as well. And like Indian government always emphasize on the transfer pricing approach, the benchmarking at the TPCR you need to maintain while submission of any transfer pricing assessment to the TPO, transfer pricing officer. So it is followed across globe, like India already discontinue the domestic transfer, specified domestic transaction, only applicable to in case of transaction between the related party, and one related party is subject to 115 BAV, the manufacturing corporate tax. So in such a scenario, and if you are taking the tax holiday benefit, then you are subject to SDT, specific domestic transaction tax. Otherwise, you are not subject to SDT. So but you are subject to international taxation each and every international transaction. If the value is less than 1 CR, then you do not need to prepare the TPCR. Otherwise, you need to prepare a TPCR as well. So this is, I covered everything here. So if any person is having the doubt, so he can just please raise the questions.
Sir, we have one question from Mr. Rakesh Kumar Sinha.
Yes, ma'am. You
would be able to view it in the published section.
Yes, Mr. Sinha. Yeah, thank you for this useful question. Mr. Sinha, if you see, like in across the globe, like in Middle East, you can see that there is no specification with respect to doing this international taxation, but most of the big fours and the international firms are preferred to take the ACCA, and in the US they are taking more interested to take involvement agent and the CPA, and in UAE I have seen them observe that like the even in Indians cost and management accountants are also doing a good job in UAE. I have seen that few are working as indirect tax or the real estate transaction tax in Saudi Arabia as well. So because in countries like where the local qualification was not there, so in terms of tax audit, so tax audits is inspections. It generally concluded by it is allowed by the local tax law. In UAE, the ACCA has allowed to do the tax audit and everything. And uh, I've seen that that other professionals are also doing, but I've not observed that other than ACCA, CPA, and other tax consultant are doing this. Even in UK, the Institute of Chartered Accountant of England was. So they are involved in the tax audit and international taxation. So so I observed that that in UAE, people, the government has demanded, because in US we have a good lobby of CMAs, but they are more in the management accountancy. So but like in case we develop a good international taxation knowledge, good knowledge about the taxation, definitely we can grow up faster, and we can means it is only about the knowledge mechanism. If we build a good knowledge among us, then definitely there is no barriers for us that who can stop us, who can prevent us from any like rights, whether it is a right for any audit or for anything. Because if we are in good members, good knowledgeable members, if we will sit in a good position in the organization for the taxation profile, and we can develop among our because this international taxation matters for CBCR, the country by country reporting, the master file, the local files. It is not required by any professional degrees. It is required by the logical knowledge that you must be aware about the international. You must be about the international taxation. You must be familiar about the OECD transfer pricing and the United Nation transfer pricing regulation and the guidance. And the benchmarking you can perform. There are many softwares are available, so you can prepare its benchmarking analysis. And already Section 92 CC, they already 92C already specified the criteria. So everything is there in the Act. Even as per the Section 288, you have a power to represent before the authorities, and you can appear before the ITAT as well in income tax in India as well. But since we are not in good numbers, we are not in good reputed positions across the parliament and the government, we are in more in the cost audit and the management part and the financial accounting. So that is why we are not getting, you can say that, good popularity among the people. So if we will increase our level of knowledge, understanding with regards to international taxation, where there is no specification is required, we can go there, adopt this approach and follow this. And definitely the other firms, and even we can establish our firms as well. With the taxation, we can collaborate with other international expert as well, and we can develop a good amount of good firms in India. Those can advise to the entities in India, because if you have a good qualities of people, you have a good profile, definitely like no corporate wants to because the foreign entities are coming day and day in India, so they are not familiar about what are the local qualification, what the international qualification, who is the popular qualification in India, and for them, each and every member, each and every profession is equal. So if we develop a good knowledge, it is a good ample opportunity for us that we can show our talent skills with the representative of the government as well. Most of the times in the webinars and seminars, in the conference as well, we are more emphasizing on the cost audit. But with the cost audit, we can give a good example about the taxation as well. That we are not in the financials audit or in the cost audit, we have a good amount of members in the taxation as well. Because I have seen people are there, but they are not publicly, they are very silent. They are doing, they are not, they do not want to come to the public. So, but people are there. Means I have observed that people are there, but not in the large number as compared to other professionals. But if we develop or understand or explain to our members the importance of the international taxation, and we can give more focus in our syllabus and regular classes. So definitely, like in some years, we can become a good institute with respect to international taxation, and we can give not even we can advise to the local bodies, local government, local corporates. We can go for international as well.
Yes, sir.
So generally, Mr. Sinha, I have checked. I was part of Spain. I was part of UAE. I was part of Saudi Arabia, Oman, Qatar, Bahrain. Gulf are recently moved to the corporate taxation. Oman recently announced the income tax of employees, 5% they are going to start from 2028. So Saudi is thinking about to implement under the new strategy of the leadership of Crown Prince Mohammed bin Salman, and even UAE also thinking about uh, 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 to take some benefit from employment, because now most of their employments are from like the Asian part, like India, Pakistan, and Bangladesh. The most of the peoples are living there. So they are, all countries are thinking about to levy income tax, but for any tax audit, because tax audits are not mandatories across the world, because like whenever you're filing the return, there is no requirement to review it or anything, because like in UAE, there is no requirement to review it from your tax consultant. You need to file it. You need to prepare it and file it. But you need to prepare one transfer pricing report that has to be signed by the professional accountant. So which could be chartered accountants or which could be ACCA as well. So because the Institute of Chartered Accountant in England and Wales are very old institutes, and all these Middle East countries have implemented the taxation with the help of UK authorities or UK tax consultants. So that is why they developed the policies, developed the mechanism followed by the Institute of Chartered Accountant of England and Wales. So that is why they are prescribed that accountants, chartered accountants, or the association of ACCA as well. So even the England but they are mostly recognized with the international accountants rather than a particular lobby for any tax point of return, like the transfer pricing returns. That has to be vetted by, that is to be signed by and certified by a accountant in UAE, in Saudi Arabia, Oman, Qatar, and every jurisdiction. So mostly I have seen that the people are ACCA and the part of England and the Chartered Accountant Institutes, and they are CPA as well from US. So ma'am, I think Ms. Prinka, I think we have covered up all the things. And
Yes, sir.
yeah, so Mr. Sinha point, I have reverted on this as well. So I think it is
Okay,
a good
sir.
that we have received very limited queries. So that means that it's
We'll
fortunate for me that that I'm able to explain the things to each and every members and able
Yes.
to resolve their queries. And in
Yes.
case of any further query, they can
We will definitely get back to you, sir.
yeah, they can get back to me, and I will revert on that. And
Okay.
hopefully that we will continue with these seminars, because this webinars are very useful in terms of international taxation, and we can cover up other matters as well, which are very important and where there is no specified qualification is required.
Okay, sir. Thank you so much. Thank you for your
Okay.
time, sir.
Thank you for your time. Thank you, everyone. Have a good day. Bye.
Thank you, sir.